While being slightly fast-paced, while being closed for the weekend, BigBear.ai Holdings Inc., trading under the ticker BBai, concluded its last session on Friday, September 19, 2025, at a closing price of $6.85. This represented a significant intraday surge of 9.08%, a volatile move that has become characteristic of the stock. But to fixate on that single day's gain is to miss the far more compelling and dangerous story unfolding beneath the surface. The common expectation, fueled by a relentless news cycle and the intoxicating hype surrounding anything labeled artificial intelligence, is that BigBear.ai is a rocket ship on the launch pad, a smaller, more agile version of Palantir, poised to capture a massive share of the burgeoning AI and defense intelligence market. This narrative paints a picture of explosive growth, positioning the company as a key player in a technological revolution. The reality, however, is a far more complex and precarious tableau, one defined by a stark and widening chasm between its stock's speculative fervor and the sobering fundamentals of its actual business operations. The truth is that BBai is a paradox, an entity whose market valuation seems almost entirely disconnected from its declining revenues, widening losses, and a worrying dependence on government contracts that have shown signs of stalling. This tension between the market's euphoric expectation and the company's faltering reality is the central battleground where the future of this stock will be decided. The recent trading activity in BBai has been nothing short of a whirlwind, a clear indicator of the speculative mania gripping this corner of the market. On Friday alone, over 156 million shares changed hands, a figure that dwarfs its average trading volume and speaks to the immense interest from retail traders and institutional players alike. This is where platforms like Robinhood and SoFi Invest become critical theaters of action. The accessibility of Robinhood stock trading and the user-friendliness of the SoFi investing platform have empowered a new generation of investors to pile into high-beta, high-risk names like BBai, often driven by headlines and social media sentiment rather than deep financial analysis. We saw the stock jump on news of a partnership, only to fall days earlier as enthusiasm from previous contract announcements faded. This kind of whiplash price action is a hallmark of a stock detached from its intrinsic value, trading instead on narrative and momentum. While some might see this volatility as an opportunity, seasoned investors using more sophisticated platforms like Interactive Brokers, known for its advanced Interactive Brokers trading tools, would likely view this with extreme caution. The options activity has been similarly frantic, with heavy betting on both further upside and a potential collapse, indicating a deeply divided market. This isn't the steady, confident accumulation you see in a blue-chip stock like Apple stock or an industry titan like Nvidia stock. Instead, it's the chaotic signature of a battleground stock where bulls and bears are locked in a high-stakes tug-of-war. The institutional ownership data further complicates the picture. While major players like Vanguard and BlackRock have increased their positions, suggesting a long-term belief in the AI sector, a significant portion of the institutional activity comes from high-frequency trading firms and hedge funds, more interested in short-term arbitrage than in the company's 10-year plan. This is a crucial distinction for anyone considering an online investment in BBai. A look at the order books on a professional-grade system like the Interactive Brokers platform would reveal a constant flux, a rapid-fire exchange of buy and sell orders that underscores the instability. While a retail investor on the Robinhood app might only see the green percentage gain, the underlying market mechanics tell a story of profound uncertainty. To truly understand the risk and the disconnect, we must pass the ticker and examine what BigBear.ai actually does. The company operates at the intersection of artificial intelligence, machine learning, and data analytics, providing decision intelligence solutions primarily to the U.S. government with a focus on defense and intelligence communities. Its business is split into two main segments: cyber and engineering and analytics. They aim to help organizations make sense of vast, complex data sets to predict outcomes and make better decisions, a service with undeniable demand in the modern world. They offer solutions for supply chain management, autonomous systems, and cybersecurity. On paper, this sounds like a recipe for success, tapping directly into the secular growth trends of AI and national security. The company boasts of a total addressable market projected to grow from $80 billion to over $272 billion by 2028. This is the expectation part of the narrative, the story that gets investors excited. However, the reality is found in their financial statements. In the most recently reported quarter, revenues fell by 18%, a shocking decline for a company supposedly in a hyper-growth phase. This wasn't an anomaly. It followed another decline in the previous quarter. Management was forced to slash its full-year revenue guidance significantly, blaming postponed government contracts. This points to the core vulnerability of its business model, an over-reliance on the federal government, where budgets are political and contract approvals can be slow and unpredictable. While the company has made efforts to expand into the commercial sector, with recent announcements like a partnership with the Washington Commanders and a deployment at Nashville International Airport, these are, as of now, small victories in a much larger war. The company's unprofitability is also a major red flag. Net losses widened dramatically in the last quarter, and its gross margins have been inconsistent. This is not the financial profile of a thriving tech company, but rather one that is struggling to convert its technological promise into sustainable financial performance. Investors looking for reliable growth through Fidelity ETFs or stable Fidelity mutual funds would find BBai's profile alarming. The company's balance sheet and cash flow situation only add to the concerns, raising questions about potential future capital raises, which could dilute existing shareholders. Looking forward, the path for BigBear.ai is fraught with both tantalizing possibilities and significant perils. The bull case hinges on the expectation fully materializing. If the AI market continues its explosive growth, and if BigBear.ai can successfully execute its strategy, the potential is immense. A major catalyst would be the successful conversion of its substantial backlog, reported at $380 million, into actual recognized revenue. However, the fine print is critical. Only a tiny fraction, just over 4% of that backlog is currently funded. The rest represents potential contracts that are not yet secured. Another major catalyst would be a decisive and successful push into the commercial sector, diversifying its revenue stream and reducing its dependence on the whims of government spending. If its AI solutions can prove indispensable to private enterprises, it could unlock a vast new avenue for growth, justifying the kind of valuation that has so far been based more on hope than on results. This is the scenario that keeps long-term believers invested, perhaps using a self-investing approach through a Fidelity brokerage or a SoFi Invest account. They might even see it as a component of a high-risk portfolio managed alongside more stable investments within Schwab Intelligent portfolios. However, the bear case is equally, if not more, compelling, and it is rooted firmly in the reality of the company's current situation. The primary risk is the continued delay or loss of government contracts. The U.S. government is a powerful but fickle client. A shift in political priorities or budget allocations could severely impact BBai's top line. Competition is another major threat. While often compared to Palantir, BBai is a much smaller player in a field crowded with giants like IBM and a host of agile, innovative startups. Palantir, in stark contrast to BBai, has demonstrated strong revenue growth, particularly in its commercial sector, and is consistently profitable. The comparison, frankly, does a disservice to Palantir and creates unrealistic expectations for BBai. The persistent unprofitability and negative cash flow cannot be ignored. In a higher interest rate environment, the market is less forgiving of companies that burn through cash without a clear path to profitability. The AI hype that has lifted the Tesla stock and the Nvidia stock to astronomical heights has also lifted BBai. But if that sentiment were to cool, stocks with weak fundamentals would be the first to suffer a brutal correction. Comment below. Do you believe BigBear.ai's dependence on government contracts is its greatest strength or its most critical vulnerability? In conclusion, the story of BigBear.ai is a cautionary tale for the modern investor, a stark illustration of the dangers of chasing narrative without scrutinizing the underlying reality. The expectation, heavily promoted by the broader market enthusiasm for artificial intelligence, is that of a nimble, high-growth tech disruptor on the cusp of dominating the national security and commercial analytics space. The stock's volatile, high-volume trading reflects this speculative hope. However, the reality, as revealed by a dive into its financial reports and business model, is that of a company struggling with declining sales, widening losses, and a precarious reliance on a single major client category. The chasm between its nearly $2.5 billion market capitalization and its $130 million revenue forecast is vast and, for the cautious investor, deeply unsettling. While the promise of AI is real and the company's technology may well